Welcome back, ladies and gentlemen, to another episode of our Economic Deep Dive series. Today, we're dissecting some critical global economic developments, especially as they relate to pending job market data, inflation, and central bank decisions. Our journey takes us across the globe, focusing on the US, Europe, China, and beyond. While central bankers are issuing statements to offer reassurance, the unsettling truth is that uncertainties over inflation, labor market weaknesses, and looming risks of recessions are still lurking in many corners. Let's zoom in, take a satirical look at this global economic puzzle, and ask, how did we get here? Why are governments and central banks struggling so much to keep inflation and job markets stable after the pandemic shocks? For those of you staying with me today, keep an eye on how the world's policymakers are stuck between trying to fix issues they themselves often exacerbated. And now in 2025, the consequences are more visible than ever. So grab your coffee, sit back, and let's dig in, starting with the US. First, we've got the US labor market and the Federal Reserve's performance. According to estimates, the US created around 160,000 new jobs in December of 2024, down from forecasts of previous years but still touted as firm job growth by many. Let's not forget, payroll growth looks sluggish because we're comparing numbers to the last 3 years, which saw a boom. It begs the question, is this so-called firm job growth enough? The employment data shows some recovery from hurricane distortions and strike activity earlier in 2024, yet should we be celebrating these base-level improvements? The Fed, under pressure from President Donald Trump v.2.0, keeps talking about holding steady despite inflation barely calming down. All this while US workers are left navigating jobs with stagnating wages and looming inflation. Now, let's address the elephant in the economic room, inflation. The US labor market has softened a bit, and we've seen hourly wages growth ease. The unemployment rate is holding at 4.2%, solid by historical standards but indicative of structural issues in certain sectors like service industries and construction, where job creation has significantly slowed. But let's be blunt. Even with easing inflation pressures, the Federal Reserve continues its cool-headed approach, all but conceding that inflation gradually dissipating is the best they can offer. Yes, it sounds okay compared to the nightmare that was 2022, but at 3–4% inflation for core categories like housing or food in certain states, regular workers feel the pinch. Many folks say, wait a second, wasn't the Fed supposed to drive inflation down to 2%? You might think it's a straightforward policy target, but here we are, with officials philosophizing about how it's just tough reaching that 2%. Meanwhile, investors are waiting eagerly for the next twist. Come Wednesday, the Fed's December meeting minutes will be made public, and you can bet stock market hawks will scrutinize every word. They'll be searching for clues about those rate cuts that Fed officials wish upon like magic spells. But let's not be fooled. Whether it's Beth Hammack, the Cleveland Fed's lone dissenter, or Mary Daly ramping up rhetoric on the inflation fight, it's ultimately clear that U.S. monetary policy has been reactive at best, not proactive, throughout this entire post-pandemic recovery arc. And the job openings? They're still hovering around 1 million more than the best-performing years pre-pandemic. Are we really celebrating that while wages stagnate? While this looks great for companies, it hasn't exactly been good for the work-to-the-bone employee holding 2 jobs at miserable pay. Now let's shift gears and fly over to Europe. It's safe to say that Europe has got a whole new set of problems, starting with inflation. The euro area, dealing with sluggish recovery since 2020, is consistently battling an inflation not similar to that of the US, but worse. Inflation data from France, Germany, and Italy, the big 3, all point to troubling patterns. What's driving it? Higher fuel prices mainly, sparking deterioration in consumer confidence and business investment. When we look at Europe's biggest economy, Germany, the situation boils down to one thing: manufacturing stagnation. As of late 2024, factory orders and industrial output reports showed consistently weak numbers. Output in November fell 7.8%, and leading indicators for December aren't painting a better picture. Picture this: the manufacturing powerhouse of Europe, which has long exported cars and machinery, has ground to a slow, almost recession-like halt. And what has Europe's central bank done? Well, they target inflation, crossing their fingers and hoping the energy crisis resolves, but this still doesn't address deeper issues in demand, export competitiveness, or even trade disruptions with Asia. Europe's own labor market is cooling, too, but, shock of shocks, ECB officials haven't been any swifter in their responses. Just like their Fed counterparts, ECB members continue defending marginal moves like a 25 basis point increase or decrease here or there, without fully addressing the elephant in the room. There's just a growing disconnect between high inflation and weak wage growth. Ladies and gentlemen, it's a meltdown in slow motion. The European Central Bank, ECB, has consistently missed its inflation target, and workers in Spain, Italy, and Germany are getting squeezed between higher living costs and stagnant wages. It's little wonder that factory orders out of France and Spain continue to show plummeting industrial output. Even Germany can't seem to kick its manufacturing machinery back into gear, despite being the core engine of European output. If you think that this is where things end, well, stay tuned, because we haven't even delved deeply into Italy's banking mess. Next on our radar is China. And oh boy, China's problems are far from behind it. Several rounds of government stimulus seem to be working as well as a band-aid on a crack in the dam. More stimulus measures, yet, December's CPI index shows deflation might already be taking hold. While the Fed and ECB dabble in interest rate games, China is watching demand falter across the board. If you wanted a textbook example of all stimulus and no demand, China fits the bill. As a social experiment, China has become a prime example of what occurs when a once booming economy falters as consumer confidence wanes. Consumer spending is weak, industrial production output struggling at best, and exports are down. President Xi Jinping is trying his best to keep the economy afloat through support measures, but truth be told, Chinese households are keeping their wallets tightly shut, amid housing market downturns, high private debt levels, and now, a chilling of the job market. We could easily charitably call this a soft economic landing, but when the Producer Price Index, PPI, continues contracting for months on end, one starts to worry about the lack of upward trajectory. Likewise, public sector efforts to rejuvenate sectors like real estate have pretty much flopped. Can China fix this? They are throwing the proverbial kitchen sink at the problem, but in the words of many former central bank chiefs, what China needs is demand-driven growth, not supply-side relief through stimulus. Turning to Canada, they're battling similarly awkward problems. The unemployment rate soared to 6.8% in November, and analysts are left wondering, how did North America's safe haven nation suddenly spiral into this employment crisis? Canada imports a tremendous amount of manufactured goods from the US, and the Canadian dollar's relative strength vis-a-vis the US hasn't done its exporters any favors. Factories have either shuttered or turned to cost-cutting measures that are leaving workers behind. Meanwhile, Colombia and Mexico are seeing multi-month declines in inflation after disastrous earlier spikes. Remember the 15% plus inflation in Colombia last year? Yeah, that's calmed slightly, but growth remains far too anemic to celebrate. Brazil, on the other hand, faces inflationary pressures of around 5%, halfway decent by regional standards, but well beyond its target given the broader economic conditions. Globally, 2025 is shaping up to be an uncomfortable year. Despite ample predictions about inflation slowing and labor market stabilizing, data is beginning to show that governments and central banks are still fumbling the bag when it comes to implementing sustainable, long-term economic policies. Wage suppression, industrial slowdowns, and the never-ending inflation jitters, central banks still can't agree on how aggressive they need to be, will make this year perhaps even trickier than 2024. Ultimately, when you combine sluggish growth in places like the US, Europe, and Canada, with emerging deflation pressures in China, Southeast Asia, and political instability in Latin America, you've got a recipe for economic headaches on all sides. Governments globally need to not only manage these growing pressures, they also bear responsibility for many policies that helped exacerbate these problems in the first place. Will central bankers and politicians work together for once instead of tinkering in isolation? One can only hope. In conclusion, friends, what should we expect? Plenty of cautious optimism, perhaps unjustified, more patchwork policies, and ultimately, more turbulence in both job markets and inflation. Stay tuned as we navigate this economic road together, and let's question the power at play, ensuring we hold governments accountable for getting us out of this mess that they've all too conveniently buried under jargon and excuses. Until next time, keep investing wisely, or at least, hedge your bets because in this economy, you may need it.